Welcome to the deep dive. Today we're jumping straight into something pretty fundamental in finance. The differences between IFRS and GAAP.
International financial reporting standards and generally accepted accounting principles. Yeah. Two big frameworks.
Exactly. We've looked at the core distinctions, and really, our mission is just to give you a clear picture of why these differences matter when you're looking at financial info.
Absolutely. And maybe the best place to start is their, basic philosophy.
Right. IFRS, that's the international one. It seems more principles-based.
It is. It relies more on broad concepts, interpretation, professional judgment. The idea is flexibility to fit different situations.
Okay, so more about the spirit of the rule, and GAAP, typically U.S. GAAP, that's known for being rules-based, right?
Very much so. Much more detailed, specific guidelines for lots of scenarios. It aims for, consistency, maybe less ambiguity.
Which sounds good, but maybe less flexible.
That's the trade-off, and you see it play out in areas like revenue recognition.
Ah, yes. How companies book their sales. How does that differ?
Well, IFRS has a single main standard, IFRS 15. It focuses on control passing to the customer, performance obligations being met. Pretty conceptual.
Okay, seems straightforward enough.
GAAP historically has had much more detailed industry-specific guidance, lots of criteria. The recent standards have converged somewhat, but the underlying approach was different.
More complex, maybe.
Often, yeah. Aiming for that high degree of specificity.
Got it. Now, something that really jumped out from the material was inventory, specifically LIFO.
Ah, last in, first out. Yeah, that's a classic difference.
IFRS says no LIFO.
Correct. IFRS prohibits LIFO. The argument is often that it doesn't usually reflect the actual physical flow of inventory and can distort earnings.
But GAAP allows it.
It does. And a big reason, often cited, is its tax implications in the U.S., especially when costs are rising. It can lower taxable income.
Interesting. Okay, what about investing in the future, like research and development costs?
Yeah, R&D. That's handled quite differently, too. Under IFRS, you can actually capitalize some development costs, not research, but development, if certain criteria are met.
Meaning treat them as an asset on the balance sheet.
Exactly. The idea is they'll generate future benefits, but GAAP generally requires you to expense all R&D costs as they happen.
So under GAAP, those costs hit your income statement right away.
Pretty much immediately, yeah. It's seen as more conservative, perhaps reflecting the uncertainty of R&D success.
Okay, and leases. I know there were big changes recently, bringing most leases onto the balance sheet for both.
That's right, a major convergence point. Both systems now require recognizing lease assets and liabilities for most leases. Big shift.
But are they identical now?
Not entirely. The criteria for classifying leases, like finance versus operating, and how the expense flows through the income statement. There are still some subtle differences in the mechanics.
Okay, so similar principle, different details. What about just how the financial statements look?
Yeah.
The presentation.
Good point. IFRS generally allows more flexibility in how companies present their statements, like the format of the income statement.
More choice for the company.
Yeah. GAAP tends to be more prescriptive, mandating specific formats and line items. The goal there is often comparability between companies.
Right. Easier to compare apples to apples, at least within the U.S.
Exactly. Now, what about when assets lose value? Impairment.
How's that handled?
IFRS typically uses a one-step approach. You compare the asset's carrying amount to its recoverable amount. If it's lower, you recognize the loss.
MGIP.
GAAP often uses a two-step test. First, you see if the carrying amount is even recoverable from future cash flows without discounting. Only if it fails that test do you then calculate the actual impairment loss based on fair value.
So potentially different timing or amounts for recognizing losses?
It can lead to that, yes. Different thresholds.
One last area, fair value. Using market prices for valuation.
Right. IFRS tends to use fair value measurement more extensively across different types of assets and liabilities compared to GAAP.
So market fluctuations might have a bigger impact on IFRS balance sheets sometimes.
Generally speaking, yes. GAAP might rely more on historical cost in certain areas where IFRS allows or requires fair value.
Okay, so wrapping this up, it really feels like the core difference is that IFRS is more principles-based, relying on judgment.
While GAAP is more rules-based, aiming for detailed guidance.
Yeah.
And that core difference just ripples through everything.
Revenue, inventory, R&D, impairment, fair value. It impacts how you actually account for and report so many key business activities.
Absolutely. And that's crucial for anyone analyzing financials. You need to know the underlying language,
Definitely. Which leads to a final thought, I guess. Do these different approaches, principles versus rules, maybe reflect something deeper,
How so?
like maybe different legal traditions or even business cultures in the places where they're dominant? Does it suggest different views on professional judgment versus needing everything spelled out?
That's a really interesting question. Flexibility versus prescription in something as critical as financial reporting. Definitely something to think about.
Food for thought indeed.
Yeah.
Thanks for breaking that down.